Imagine waking up tomorrow and discovering that your entire investment portfolio has disappeared. Not because the market crashed, not because a company went bankrupt, but because you spent years trying to beat the market and quietly lost to something much simpler. A fund that doesn't predict the future, doesn't hire celebrity investors, doesn't promise the next big stock. It simply follows the market. And strangely enough, that boring strategy has quietly created millions of millionaires. Which raises an uncomfortable question. If something this simple works so well, why do so many people ignore it? Because in finance, simple rarely feels exciting. We are taught that successful investing means finding hidden opportunities before everyone else. The next Apple, the next Nvidia, the next stock that turns $1,000 into $1 million. Financial television runs 24 hours a day trying to answer that question. Social media is filled with people claiming they've already found it. Entire industries exist because people believe someone, somewhere, knows which stock will explode next. But what if that assumption is wrong? Imagine walking into the world's largest supermarket. Instead of buying one product, you somehow own a tiny piece of every product on every shelf. The cereal, the toothpaste, the coffee, the medicine, the electronics. No matter which brand becomes more popular next year, you benefit because you own them all. That, in a surprisingly simple way, is what an index fund tries to do. Instead of betting on one company, it spreads your investment across hundreds or even thousands of businesses. Some fail, some struggle, a few become giants. Together they form the market itself. To understand why this matters, we need to go back almost 50 years. In the 1970s, investing looked very different. If you wanted to invest, you usually paid professionals to manage your money. These managers researched companies, read financial reports, visited headquarters, held endless meetings. The promise sounded reasonable. Experts should outperform ordinary investors. After all, that's what expertise is supposed to do. Then something awkward happened. Researchers started comparing professional fund managers against the market itself, year after year, decade after decade, and the results were surprisingly disappointing. Many professionals did beat the market for a while, but very few kept doing it consistently. One great year often became 3 average ones. One lucky streak eventually disappeared. The market had an annoying habit. It was incredibly difficult to outsmart. This created a strange idea. Instead of trying to beat the market, why not simply become the market? That idea became the index fund. An index is simply a list. Think of it like a scoreboard. One famous index tracks 500 of the largest publicly traded companies in the United States. Another tracks thousands of companies across different countries. An index fund simply buys those companies in roughly the same proportions as the index. Nothing magical, nothing secret, no crystal ball. If one company grows larger, the fund automatically owns more of it. If another company shrinks, its importance naturally becomes smaller. The fund quietly adjusts over time without anyone needing to predict the future. This simplicity creates something surprisingly powerful. Imagine investing in only one company. Maybe it invents revolutionary technology, or maybe it disappears within 10 years. History is full of companies that once looked unstoppable. Some dominated entire industries before fading into irrelevance. Now imagine owning 500 companies instead. A few will fail, many will perform normally. Several will become global giants. The winners gradually outweigh the losers, without you needing to know in advance who those winners will be. This is diversification. It's one of those financial words people hear constantly. But underneath the jargon is a very human idea. Don't let your future depend on one guess. Because investing isn't really about proving you're the smartest person in the room. It's about avoiding mistakes that permanently damage your wealth. This becomes even more interesting when costs enter the picture. Imagine 2 investors. Both earn exactly the same market return. One pays almost nothing in annual fees. The other pays 1% every year. 1% sounds harmless, almost invisible, barely noticeable. But investing has an unusual relationship with time. Small percentages don't stay small, they compound. Every dollar lost in fees is a dollar that never compounds again. Over 20 or 30 years, that seemingly tiny fee can quietly consume tens or even hundreds of thousands of dollars depending on the portfolio size. Not because someone stole your money overnight, because it slowly leaked away, like a bucket with a hole so small you barely notice it. Until years later, many index funds became popular for one simple reason. Their fees were dramatically lower than actively managed funds. Less money spent trying to predict the market. More money left invested. And over long periods, that difference mattered. Now here's where people often misunderstand index funds. They think they're safe. They're not. If the stock market falls 30%, an index fund falls too. During financial crises, even diversified portfolios can lose significant value. There are no magical shields. No investment that permanently goes upward. The difference is that an index fund isn't trying to avoid every storm. It's built on the assumption that economies recover. Businesses adapt. New companies replace old ones. Innovation continues. The names inside the index gradually change over decades. Railroad companies once dominated, then oil companies, then industrial manufacturers. Today, technology firms occupy much larger positions. The index quietly evolves without asking investors to predict which industry comes next. That's one of its most overlooked advantages. It removes the need to constantly guess, which sounds almost boring. And that's exactly why many people struggle with it. Human beings like action. We feel productive when we're making decisions. Buying, selling, checking prices every hour, reacting to headlines. Doing nothing feels irresponsible. Yet investing often rewards patience more than activity. There's an old irony in finance. The more exciting an investment feels, the more dangerous it often becomes. Meanwhile, some of the wealthiest long-term investors built fortunes doing something that looked almost uneventful. They kept buying. They kept holding. They ignored the daily noise. That doesn't make headlines. Nobody posts viral videos celebrating another month of disciplined investing. Because consistency is visually boring, but financially powerful. Imagine investing a fixed amount every month. Some months prices are high. Other months they're frighteningly low. Without realizing it, you're buying fewer shares when markets are expensive and more shares when they're cheap. Over decades, this smooths out many emotional decisions that hurt investors. Not because timing suddenly became easy, because timing stopped mattering as much. Contrast that with the average investor. Markets fall. Fear takes over. They sell. Markets recover. Confidence returns. They buy again, ironically paying higher prices after selling at lower ones. It's a pattern repeated throughout financial history. Not because people lack intelligence, because emotions don't disappear the moment money is involved. Index funds quietly reduce the number of decisions you have to make, and fewer emotional decisions often lead to better long-term outcomes. Perhaps the strangest part of this entire story is that there is no secret ending. No hidden stock. No exclusive strategy available only to insiders. The idea is almost disappointingly ordinary. Own productive businesses. Keep costs low. Stay diversified. Remain invested. Give time a chance to work. That's it. Which explains why this approach often feels too simple to be true. We're conditioned to believe complicated solutions must produce better results. That expensive advice must outperform inexpensive advice. That constant activity must outperform patience. Sometimes that's true. But investing has a habit of rewarding the opposite. The market doesn't care how confident someone sounds on television. It doesn't reward predictions simply because they feel convincing. It doesn't hand out higher returns to people who check their portfolio 10 times a day. It quietly rewards ownership. Ownership of businesses solving problems, creating products, employing people, and generating profits year after year. An index fund isn't exciting because it predicts the future. It's powerful because it admits something almost nobody likes admitting. The future is impossible to predict consistently. And maybe that's the biggest lesson hiding underneath all of this. The greatest investing advantage may not come from knowing more than everyone else. It may come from accepting what nobody knows at all. Because in a world obsessed with finding the next big winner, perhaps the smartest move is quietly owning them all.